Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Lisa Insalaco, mortgage broker in Cambridge, North Dumfries, on.
If you're a homeowner in Cambridge or North Dumfries, sitting on a home you've owned for decades, and your monthly income just isn't stretching the way it used to, what happens when the options you thought you had turn out to be closed?
That's the scenario Lisa Insalaco walks into regularly, and it's more common than most people realize.
So let's set the scene. A homeowner in their early 70s, Cambridge area, no mortgage left on the home, fixed income, pension, maybe some savings. The basics are covered, but barely.
Groceries, utilities, property taxes, all of it has gone up. The cushion that used to exist is gone.
And the home itself has appreciated significantly. There's real wealth there, it just isn't liquid.
That gap, between the wealth that exists and the cash that's actually available month to month, is exactly where Lisa Insalaco's work as a reverse mortgage specialist begins.
Before we get into how she approaches it, let's talk about what most people in that situation try first. Because the reverse mortgage is rarely the first call someone makes.
Right. The first instinct is usually a HELOC, a home equity line of credit. You've got equity, you want to borrow against it. That seems like the logical move.
And the problem is?
Income qualification. A HELOC requires you to demonstrate that you can carry the payments, and for someone on a fixed pension income, that bar is very hard to clear.
So the system is essentially saying, you have the asset, but we can't lend to you because your income doesn't fit our model.
Exactly. And a conventional refinance has the same problem. You pull equity out by increasing the mortgage, but now you have a monthly payment, which adds pressure instead of relieving it.
Which is the opposite of what this person needs.
Downsizing comes up too. Sell the bigger home, buy something smaller, pocket the difference. And that's a real option, but it means moving costs, land transfer taxes, real estate commissions.
And leaving a home you may have lived in for 30 years.
For a lot of people, staying put isn't just a preference. It's the entire point.
So that's the system failure Lisa Insalaco sees repeatedly in Cambridge and North Dumfries. The standard tools don't fit the situation.
And the reverse mortgage is specifically designed for exactly this scenario, where conventional qualification is difficult, monthly payments aren't workable, and staying in the home is the priority.
Now, before we get into how Lisa Insalaco walks clients through this, we have to address the fear. Because there's a question she says comes up more than any other.
If I get a reverse mortgage, does the bank own my house?
And it's not a naive question. It reflects a real fear, that accessing equity means giving up the home, or that a lender could force a move before you're ready.
Lisa Insalaco is direct about this. The answer is no. You remain the registered owner of your home throughout the life of a reverse mortgage.
The lender holds a mortgage registered against the property, same as a conventional mortgage, but they don't hold title, and they cannot force a sale while you're living there as your primary residence.
The loan becomes due when you sell, move out permanently, or pass away. Until then, you live in the home on your own terms.
That's a structural reality of how the product works, not a marketing promise.
And for homeowners in Cambridge and North Dumfries who've lived in their homes for decades, that distinction matters enormously.
There's also a spousal protection piece that Lisa Insalaco flags specifically. If two spouses are on title, both need to be named on the reverse mortgage.
Which means the loan doesn't come due if one spouse passes away, as long as the surviving spouse continues living in the home. That protection is built into the product's terms.
Now let's talk about who actually qualifies. Because eligibility is more accessible than a lot of people expect, but there are firm requirements.
The age threshold is the first thing Lisa Insalaco confirms with anyone who reaches out. All borrowers on title must be at least 55. That's a firm line set by the lenders who offer this product in Canada.
And the property has to be your primary residence. Vacation properties, investment properties, those don't qualify.
Detached homes, semi-detached, townhouses, some condominiums, generally eligible, but lenders assess each property individually.
The income and credit picture is meaningfully different from a conventional mortgage. Because there are no monthly payments required, lenders aren't stress testing your ability to carry a payment the same way.
The focus shifts to the property itself, its value, its condition, its location. Credit history is still reviewed, but the bar is different.
And the loan amount is capped as a percentage of the home's appraised value. Lisa Insalaco is clear about something important here for the Cambridge and North Dumfries market specifically.
Property values in this region are meaningfully lower than in the GTA. The percentage doesn't change, but the dollar amount does.
So if someone is doing the math on whether a reverse mortgage solves their specific cash flow problem, they need to run those numbers against local property values, not GTA headlines.
That's exactly the kind of grounding that Lisa Insalaco brings to these conversations as a mortgage broker working in this specific market.
Let's talk about how the money actually gets to you. Because the payout structure matters a lot depending on what problem you're solving.
There are two primary options. A lump sum. You receive the full approved amount at once. Or a scheduled advance structure, where funds are released in installments over time.
Some lenders offer a combination of both, an initial lump sum with the option to draw additional funds later.
For homeowners dealing with ongoing monthly budget pressure, the scheduled advance is often more useful than a lump sum. You're only accruing interest on what you've actually drawn, not the full approved amount.
Which brings us to the trade-off that Lisa Insalaco walks every client through before anything is signed. The interest compounds over time.
The longer the loan runs, the more interest accumulates. The numbers look very different over 5 years versus 15 years.
And that's not a reason to avoid the product. It's a reason to understand the math before you sign.
Lisa Insalaco is explicit about this. She models what the loan balance looks like at different points in time, not to discourage clients, but so the decision is made with a clear picture rather than just the headline amount.
Now let's talk costs, because upfront costs are real and they need to be factored in.
The main categories are the appraisal fee, independent legal advice, and closing or administration fees charged by the lender. The Financial Consumer Agency of Canada notes these can total several $1,000s in aggregate.
Independent legal advice is not optional. Lenders require it before closing, and that requirement exists because a lawyer reviews the mortgage terms with you independently, separate from the lender's own process.
And prepayment penalties deserve specific attention. If there's any possibility of selling the home or repaying the loan within the first few years, a planned move to a retirement community, for example, the penalty structure matters a lot.
Some lenders calculate penalties based on a fixed number of months of interest. Others use a more complex formula. Lisa Insalaco goes through this carefully with every client she works with in Cambridge and the surrounding region.
Because the penalty on a reverse mortgage can be substantial if the timing doesn't work out the way you planned.
Let's zoom out for a second and talk about the equity picture over time. Because one of the questions that comes up is whether you're creating a bigger long-term problem by accessing equity now.
Lisa Insalaco's answer is that it depends on your priorities and your timeline. The loan balance grows as interest compounds. The portion of the home's value that belongs to you does shrink as the loan runs.
For homeowners whose primary goal is maintaining quality of life in the home they already own, that gradual reduction is often an acceptable trade-off.
For homeowners who want to preserve maximum equity for their estate, the math looks different, and there may be other options worth exploring first.
And she's clear that no negative equity protection is not offered by every lender or every product. Confirm directly with your lender whether it applies to your specific mortgage before signing.
What's worth noting for the Cambridge and North Dumfries market is that long-term homeowners in this region often hold substantially more equity than they expect. Property values have moved significantly over the past decade.
Which means the starting point for a lot of these conversations is actually better than the client anticipated.
That's frequently where Lisa Insalaco begins, helping someone understand what they actually have before deciding what to do with it.
Let's talk about how she structures the conversation itself. Because the process she describes is as important as the product.
The first thing she wants to know is what problem the money is actually solving. Is it a one-time shortfall or an ongoing monthly gap? Is there debt to clear? Is there a home modification that would make aging in place more realistic?
The answer shapes which payout structure makes sense, how much to draw, and whether a reverse mortgage is even the right tool.
The second thing she goes through is the numbers over time. Compounding interest changes the picture significantly depending on how long the loan runs.
And the third piece is the family conversation. Family approval isn't required. Legally, if you're on title and meet the eligibility requirements, you can proceed. But because a reverse mortgage affects what an estate looks like, many homeowners find it useful to loop in adult children before committing.
That's a personal decision, not a legal or lender requirement. Lisa Insalaco is clear about that distinction.
So what does the outcome actually look like for that homeowner we described at the top? Early 70s, Cambridge, fixed income, no mortgage, costs that have outpaced the cushion?
The reverse mortgage fits the problem in a way the other options don't. No monthly payment. No income qualification in the conventional sense. Access to equity that's been building for years, without requiring a move.
The home stays in their name. The neighborhood stays the same. The monthly pressure eases.
And the part that takes the most time, according to Lisa Insalaco, isn't the application. It's the math. How much to draw, in what structure, and what the loan balance looks like over 5, 10, 15 years.
The right draw amount isn't always the maximum available amount. That conversation is worth having carefully.
Reverse mortgage balances in Canada have reached $10.9 billion, growing at an average annual rate of nearly 21%. This is a mainstream product. A lot of Canadian homeowners have gone through this process, kept their homes, and continued living in them.
The fear of losing the house is understandable. But it's not what the product actually does, and that's the clarity Lisa Insalaco brings to every conversation she has with homeowners across Cambridge, North Dumfries, Kitchener, Waterloo, Brantford, and Guelph.
If you're a homeowner in this region and this conversation is starting to feel relevant, Lisa Insalaco is a mortgage broker in Cambridge who specializes in exactly this. And she's worth talking to before the urgency gets ahead of the decision.
The lesson here is simple. The wealth exists, the tool exists, and the right conversation makes the difference between a decision made clearly and one made under pressure. Lisa Insalaco is a mortgage broker in Cambridge, North Dumfries, specializing in reverse mortgage.